Hi, I'm Jim and I was retired. Is your retirement portfolio diversified? Morningstar just released its 2025 Diversification Landscape report, and it's packed with lots of insights on how key asset groups performed in 2024 and how their correlations have changed over time. But in this video, I'll discuss as a DIY retiree, does diversification really matter? Stay tuned. Now, diversification is related to modern portfolio theory going back to Harry Markowitz's work in the 1950s. And it's basically key to that old adage, don't put all your eggs in one basket. But this brings us back to the theory of diversification and this latest work by Morningstar. How should we think about it in retirement? Now, here's a post on X that started my thinking about diversification. Ken Tuman is one of the people I follow on X, cited Morningstar's new report, and specifically, while cash might not earn much over inflation over long periods of time, a modest allocation can provide both safety and liquidity when stocks and bonds fall simultaneously. And that was prompted by this article by Christine Benz, who co-authored the diversification research at Morningstar. And she noted in this article that cash looked even better than Treasury bonds as equity ballast. And that was her phrase. Now, I read both the article and the full white paper. Yet I replied to that X post by saying, I don't keep cash as an alternative to bonds as ballast. I keep cash to cover this year's expenses and treasuries that mature when I will need that cash. It's more about time allocation than asset allocation. And by the way, please subscribe to my X feed. I use the same handle over there that I do on YouTube. I was retired. So go click there. I'll share some comments on X related to my DIY retirement and my view of where inflation is going. Now, I've done this X feed and my YouTube channel for almost the last 5 years, but I've been tracking my DIY retirement that began abruptly nearly 10 years ago at the age of nearly 59. Now, my wife and I use a 3-bucket retirement portfolio. Bucket 1 is cash at equivalents for up to 3 years' worth of needed withdrawals for our expenses. We hold treasuries, tips, CDs, and other income-producing assets in Bucket 2 for another 5 years of withdrawals. And all our equity is in Bucket 3, and most of it is invested in low-cost, broad-based funds like VTI for U.S. market exposure. So how do I care how treasuries and cash correlate to the U.S. equities? The 2025 Diversification Landscape looked at how key asset classes performed in 2024 and how correlations have changed and the implications for portfolio building. Now, I'll put links to both the study and the Morningstar articles that I read in my details below. Now, the key takeaways from the study included that plain vanilla 60-40 portfolio gained about 15% in 2024. Diversifying into other asset classes generally led to lower returns. Over the past 20 years, several asset classes, including corporate bonds, global bonds, high-yield bonds, municipal bonds, REITs, and TIPS, Treasury inflation-protected securities, have all become more closely related to stocks. Treasury, bonds, gold, commodities, and some alternative investment strategies have been more compelling portfolio diversifiers. Morningstar's research found that cash, U.S. cash and T-bills on this chart, had the lowest correlation with U.S. markets, 0.33 compared to 0.78 for U.S. corporate bonds or 0.80 for U.S. TIPS. But these correlations are based on 3-year market returns. And those market returns were heavily influenced by 2022 results when both equity and bonds were down. But do these numbers really matter if you're holding T-bills and treasuries and TIPS, for instance, to maturity? Now, 2022 was a terrible year, and it also prompted my decision to move from a TIPS fund like VTIP to individual TIPS. When I hold a 5-year TIPS in my IRA, and you want to hold TIPS in IRAs instead of your brokerage account because of the tax implications, I don't worry about that TIPS that I purchased and its market valuations in any given year. I'm holding it until maturity and will earn an inflation-adjusted return over that 5-year term. Now, I'm holding cash in bucket one in T-bills and cash and CDs, but it's not as ballast to my equity investments in bucket three, but it's a time-segmented assets of parking them where I will need to pay bills. Hey, before I go any further, will you please take a moment to like, subscribe, and share this video with other DIY retirees if you like entertaining ideas from one DIY retiree to another. Again, I'm not a broker. I'm not a financial planner. I'm sharing my ideas with you. I don't have a book to sell. I'm freely sharing these ideas. Now, as I've done in recent videos, I asked Grok about diversification within a bucket strategy. If I hold cash, treasury bills, notes in bucket one and bucket two, and a total U.S. market fund like VTI in bucket three, do I really care about the correlations between U.S. market and cash and treasuries? I'm only holding the bills and notes to maturity, so their market performance shouldn't matter, right? Well, this is how Grok responded. Short answer, you probably don't need to worry much about the correlations between VTI, the total U.S. market, and your cash and treasuries, especially since you're holding treasuries to maturity. Here's why. When you hold treasury bills and notes to maturity, you're guaranteed to get your principal back plus the stated interest, regardless of market price fluctuation. Their market performance, which could dip if interest rates rise, doesn't affect you because you're not selling them early. This means that the price movements don't impact the portfolio's value in bucket one and two. The correlation of their market prices to VTI, which fluctuates with the stock market, is irrelevant to your strategy as you're insulated from market volatility in these buckets. Grok also pointed out that cash has a correlation of near zero with VTI because price is constant. It's cash. It doesn't trade. It's there not as a ballast, but for immediate needs and emergencies. And bucket strategy focuses on time, not correlations. Your bucket approach is about matching investments for when you need the money. Now, here's the key phrase. Since bucket one and two are safe and predictable, their correlations with VTI's ups and downs doesn't affect your ability to pay bills or fund your lifestyle. It turns out that in a follow-up article this week on the research in Morningstar, they came up with a similar answer to a similar question. How is any of your analysis affected if an investor is using the portfolio for retirement income versus an accumulation phase? When you're starting to draw down assets from the portfolio in retirement, your time horizon becomes more important. Amy Arnott noted, I would say diversification is still something you want to pursue for your portfolio, but you want to be thinking about sequence of return risks and your cash flow needs. When you're entering retirement, those types of time horizon and bucketing decisions can be as important as diversification. Now, I juggle 3 time buckets, 3 tax buckets, and an overall asset allocation. And I've shared more about bucket strategy in a whole series of videos. I prioritize filling bucket 1 and 2 before I can consider any overall asset allocation. Now, I'm currently at about 60-40, and I've made the strategic decision that we want to move towards 70-30 by the time I start Social Security at the age of 70, and that's about a year and a half from now. I focus on the overall asset allocation. That includes U.S. equity, some international equity. I'm far less. I'm about 10% is my goal. I'm at about 5 now. But I'm mostly U.S. equity. And I have a bit of REITs, and I've shared my ideal portfolio in other videos. All of that is in bucket 3 investments. And for me, diversification is a broad-based, low-cost fund for these assets like VTI or VXUS and FREL for the REIT exposure. Those are using well-grounded, broad-based indexes for those market classes. And that's the best way of getting some diversification. But again, match your investments for when you think you'll need those equities. In my case, all of those choices are in bucket 3. Frankly, I've seen the word diversification misused, often to sell insurance or gold or asset classes that may not fit your DIY retirement portfolio. Heck, just this morning, I saw this article in Financial Planning about how to use watches to diversify your portfolio. I'm not so sure. I would rather focus on lowest cost investments in my DIY retirement. It's a boglehead principle. I will conclude with my standard warning. I have no initials after my name, so take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. Bye.